so that a number of folks unfortunately are traveling and couldn't join. So I will record this and share it out after. But welcome, thank you guys for joining. This is, we've been getting, this was actually Cynthia's idea. We've been getting so many questions just blown up left and right when people reading headlines, seeing the news, saying what's going on with the market. There's a lot of kind of doom and gloom type headlines out there right now. It's crashing, we're in a bubble, it's popping, all these different things. And so I think it's really important to kind of dive into the truth and what we're seeing from our live perspectives. And one of the things that we talk about, I know several of you on here are clients, and I'm sure you've heard us talk about this mission statement. This is what Cynthia and I live by. We empower you to make smart real estate decisions that enrich your life. And you'll notice that that does not say, we help you buy a home, we help you sell a home, we help you find your dream home. None of that stuff is, homeownership is not for everyone. Homeownership is amazing for those that it's right for, and can be an incredible wealth builder in this country for so many different reasons. But we want to make sure that you are making the best decisions for you, and that if real estate is part of that, great. We will find a way to help make sure it enriches your life and that you are empowered to make those smart decisions for yourself and to meet your goals. And so the goal of this conversation with Arjun, who I'll formally introduce in just a second, is really just that. It's to give you data, to give you information, and you do with it what you want. And you do with, we will always have more conversations and dialogues about this with each of you individually if you want. But we are trying to be as unbiased as possible to really help you understand what we're seeing out there in the current market. And not, we're not the media. We are not doing this to sell clicks. This is really just to inform you. So with that, I'm going to introduce formally Arjun, who is on this panel with us. Arjun is one of our very, very top go-to lenders. As I was saying before some of you joined, he is, I think of him as so much more than this. He's an advisor. He is, I won't say you're an economist because you're not really, but you are so in touch with what's going on with the latest and greatest data. And you really are great at advising clients and helping them see the big picture too. A lot of people get so focused in the weeds and what's my exact rate right now, when really it's about the long-term picture. And I think Arjun does a phenomenal job of really helping people understand, we believe, Cynthia and I believe that if there's a will, there's a way. And Arjun is very much a part of that because he will find, the right organization to lend money for people who want to, who have home ownership as a goal. But more specifically, he is, you should follow him on Instagram. He does an amazing job with his content, and just informing people of what's going on. So his Instagram handle is there at his name. Follow him on Instagram. He's got 100,000 something followers. He does a phenomenal job. He is, the number one, his team is the number one, or his branch rather is the number one in the country with his company. He himself is number 4 at the company. He did about 100 million in loans last year. So he is very well seasoned. He's been in this business, 25 years?
21 years.
21 years. He's seen ups and downs and all around. So I'm really excited to have your perspective on this call. And as he indicated in his 2 Truths and a Lie, he's had 2 world championships. He's won gold medals in Taekwondo. So he talks about that on his Instagram too, if you follow him. All right, cool. Love the clapping hands. Yay, thanks. All right, Cynthia, I'm going to turn it over to you to kick off. Cynthia's going to be moderating our panel.
Cool. Sorry, hold on one second. I am trying to screen share.
And her dog, Magnolia.
I know. And I just closed down my browser. Or no, it's okay. So as Blakely mentioned, we are here today. I'm not sure, and please chime in. There's only a handful of us here, so please definitely chime in and let us know if you guys are seeing the same things. But we wanted to chat with you guys because of headlines like this that are just super doom and gloom. We've been seeing a ton of these hitting our feeds and causing a lot of fear and stuff like that. Housing market crash, housing bubbles, stuff like that. More recently, what we've been seeing a lot of and what we've been hearing a lot about are interest rates. And so we wanted to talk about that. As we know, the last 2 years of the pandemic, interest rates have been at a historical low, and we've just seen an increase. And so Arjun, I wanted to kind of throw the ball to you for this initial conversation about interest rates. Tell us a little bit about why they were so low during the pandemic, and then what the heck happened last week. So,
Okay. So there's a lot of misconceptions about interest rates, as Blakely said. Like, this is where a big point of confusion is. And then even headlines like you put up, Cynthia, can offer people or send a lot of mixed signals to consumers in terms of what controls interest rates and, you know, what causes them to move up, down, and what their trajectory is going to be given what's going on in the overall economy. But during the, probably, let's just say, the last 10 years, with the exception of the right around 2018, we've had rates kind of been staying in a steady decline, where mortgage rates, that is, where they've just stayed down. And then when COVID actually hit, the government stepped in, and not necessarily the Fed, but the federal government stepped in and started buying up what are called mortgage-backed securities. And I won't get too much into the economics of it, but what that basically means is they were buying the one debt instrument that actually controls, or is what is used as a gauge to set mortgage rates here in this country. And so they were buying up a lot of these securities to keep rates artificially low. And that is what brought on the historical low that you kept hearing about, that everyone was trying to either get a part, become part of, you know, take some piece of, or what have you, for those 2 years. And that obviously was only going to be served as Kool-Aid for so long. The Fed can't keep that up, because then the unintended consequence of doing that, as well as cutting interest rates, you know, for the overall economy to basically zero, is it stimulates a lot of spending. It puts a lot of money out there, and then you get inflation. And the definition of inflation is too many dollars chasing too few things, or too few product. And we see that in housing. That's, you know, where you have bidding wars. That's where you have so many people that have their hand in the air saying, I want to buy a house right now, but there's not enough homes for them. And we'll talk about inventory, I know, later today, but that was what was keeping rates artificially low. The Fed then making some announcements, you know, about 6 to 8 months ago, officially, that they're no longer going to do this. So they're basically they're not going to spike the Kool-Aid with as much sugar, so to speak. That sent a little bit of a ripple, and you started seeing mortgage rates trend up a little bit before the holidays. But then once inflation became a household term across the United States and in the news wave, everyone needs to understand, really simple, so that you get this, and then you'll be smarter than the average Joe. Inflation and mortgage rates run the same direction. So if inflation is running hot, mortgage rates run higher. And clearly now we're in an inflationary period. Everyone knows this. We're all feeling it on all levels. And until inflation kind of gets under control, we're going to see higher mortgage rates. Now, inflation will not run away out of control, because there's a lot of motivation and political currency that's on the line to make sure that it does get under control. So they'll do everything they can, you know, and most people, I know Cynthia and Blakely subscribe to this as well, that there's very good likelihood that somewhere in the next, you know, the next year or less, inflation will get fully reined in, and then we'll see lower rates. So rates go up, rates go down. It's just part of a normal cycle. But the overall takeaway for everybody here, as I close that quick point, is that the Fed does not control mortgage rates. I know Blakely's going to touch on this too, but they do not control mortgage rates. So when you hear that the Fed does something, they don't control rates. They control key interest rates, but not actually mortgage rates.
yeah.
So Arjun, when the Fed raised rates about 10 days or so ago, 75 basis points, and everyone said, oh my gosh, rates went up, meaning mortgage rates. Did they go up 75 basis points?
Oh, they did not. What happened was the key interest rate, or the federal funds rate, is what went up 75 basis points. And the mortgage rates actually responded quite well to this. Why? Because the mortgage market saw that the Fed is being very serious about tackling inflation. If they're raising rates aggressively, and it was more aggressive than what was originally called for, a 50 basis point hike was what was kind of on the books. But then as the week started approaching, people started hearing inklings that maybe it would be 75 basis points. And the mortgage market responded well to that and said, these guys are very serious about wanting to curb it. So it responded well, and you saw a rally in mortgage-backed securities, and mortgage rates come down a little bit. So it was the opposite of what the mainstream media or what the average Joe had assumed or extrapolated from that.
So where do you see, so as we look at this, so essentially what we're seeing is that mortgage rates did drop a little bit as the Fed kind of gave us a signal that we want to capture inflation under control, but we want to, and then we also want to kind of slow things down. So where do you see rates going from here?
Well, as you see here in this graph.
And what does that mean for consumers? Yeah.
Yeah, which is a really good one. So you see basically the dark tabs or lines, vertical lines, are recessions that happen. And you'll see that inflation, or which is being measured by the CPI index, the consumer price index, in blue, where it was running at peak levels or running for that cycle or that time period where it ran up. And then what ended up happening was a recession. And the reason that a recession typically happens is because when you do have high inflation, things cost so much and people spend less money. And when they spend less money, that leads to less growth, and less growth ultimately results in an inflation. When that happens for 2 consecutive quarters, calendar quarters of declining growth, that's the definition of a recession. And in recessions, you get lower mortgage rates. So a lot of people are calling, and this is by no means a forecast or prediction, but you're hearing it more, that a recession could happen. There's a lot of reason in economic data that is supporting that thesis. Whether it happens or not, we will see. Everyone's hoping for the best, of course, but recessions sometimes need to happen, and they are almost necessary, not cataclysmic ones where there's so much widespread pain, but just as a general economic cycle, they're needed to kind of flush out the excess in the way of money and capital that's in the system. So when we do see a recession, that does bring down interest rates, mortgage rates specifically, just because they'll want to stimulate the economy again. So the economy is running so hot right now. You see the Fed is raising rates to try and pull money out of the system so that we lower the amount of dollars that are chasing products. And then they could eventually turn it back on when the economy slows a bit too much because they need to ramp it back up. So it's just a game of hot and cold.
So as you know, taking all of this into consideration, you know, I'm sure and what Blakely and I are having a lot of, I feel like the last 2 years, a lot of conversations about, and of course, we just advise clients to talk to you about what they should do with their money. And it's been, you know, with 30-year fixed products and stuff being at getting interest rates in the 2s, and now we're seeing those rates are higher. We're having a lot of conversations about, hey, talk to your lender, talk to your, you know, financial advisor about the different products out there that are kind of the 5 to 7 arms, where you're going to lock into a little bit of a lower rate for a shorter time period.
Yeah.
So yeah, what are your thoughts on that? And like, how are you thinking about that in terms of all of these economic indicators and clients?
Well, I think people have to understand that the average person, the average homeowner, they might keep a home for a long period of time, but they don't stay in a mortgage for longer than 3 to 5 years. And I think that cycle for anyone getting a mortgage now is actually going to be even shorter. And when I say now, I mean in the last year. I don't think it'll be a 3 to 5 year wait before they likely will turn that mortgage over. So that being said, the current state of things is that the gap between fixed rate mortgage products and shorter term, 5, 7, or even 10 years, is starting to widen, which means there's more affordability and there's a little bit more attractiveness in a shorter term rate, because that's the trade-off. You're taking a shorter term and you're getting a lower rate in exchange for that risk. Now, the word risk I use very carefully, and I want to make sure I enunciate it a bit more here, in that it's not meaning that this is such a risky product that you could lose your house and you're not going to be able to afford the payments. These are not the adjustable rate mortgages of 15 years ago. I think that's worth mentioning. A lot of people, when they hear adjustable rate, they get it brings up PTSD or just a little bit of sticker shock and like, no, how could you even encourage me to take that? Those are the loans that cause people to lose their homes. Those were very different loan products. Many of them were interest only with no money down. And therefore, when the loans did finally adjust or recast, you had payment shock, and that's what caused people to not afford their mortgage any longer. So with these products, you are qualified at not only the rate that is being offered for the adjustable, but also for what it could adjust to in many cases, almost on a worst case basis. So they know that given your current income levels and earning capability, that you can afford this payment. But again, going back to the original point, The average person is not in their mortgage for any longer than 3 to 5 years before they end up turning it. And many people just move. I mean, you guys are both real estate agents, so you see that cycle as well. How many people have you sold a house to and they're already like, hey, we're thinking about the next move? This happens. I think the previous generation, maybe it was us, but our parents would have the homes that we still go back to. And it was the house you grew up in when you go back for the holidays. I don't think this next generation is going to say that much. There might be 4 or 5 houses somewhere in that childhood or that entire upbringing, because people just move so much more often now, and they're not as married to their homes.
Totally. I think one thing to chime in on there too, Arjun, we talk about this a lot, is if people are super sensitive because rates have gone up. Now, I also want to say, there's headlines that are there in the 6s and 7%. Most of the time, those are referencing different products than what we typically see here in the Bay, because most of our loans are jumbo loans. And also those are referencing 30-year fixed rates. So if you are comfortable and if you recognize that, hey, rates may come down in the next year or so, as Arjun was saying, then at that point, I will just refi. You may still be in your home in a year or two.
Sure.
You are, but you may not be in your loan itself that you started with. And so
Right.
you refi it after 2-3 years. So why do you need a 30-year fix? You might need a 5-year arm just to be safe, or a 7-year arm just to be safe. But if people are super sensitive, and those rates are still like, people can still get them in the 4s.
Sure.
And that's not crazy
Absolutely.
high rates. But if people are super sensitive to their monthly payment because they're comparing to their friend who bought when their rate was 2.7 at these artificial lows, one thing that we're talking to them a lot about is interest only loans. And I know you do a lot of those and are doing an increasing number of those. Can you just share what that means now in the context of today?
Yeah, I mean, from an affordability standpoint, or just to make payments cheaper, interest only loans are becoming popular again. And they are, in very layman's definition, exactly what it states. You just pay the interest only portion of the loan. And therefore, so you're not reducing your principal balance at all, unless you elect to send in extra money, whether it's $1 or several $100s per month. That's the only way you'll actually put a dent in the principal. But for the short term, if you're thinking about making an interest only payment to keep your payment cheaper, your overall housing expense cheaper, that's an option. The ARM products, like you just pointed out, Blakely, compared to where fixed rate products are at, offer also a cheaper alternative if you're looking at amortized products. And what I mean by amortized is every payment is paying down some principal and interest, not just interest only. So there's a lure in those products, but I think one thing that bears mentioning, and that old phrase that comparison is the thief of joy, right? The joy of home ownership and the joy of owning something and actually getting into something that is going to appreciate in value, that's indisputable. It's going to do well. That can be quickly negated or even lost if you're comparing to rates that were of last year, or what like you said, Blakely, what your friend got, or what your neighbor moved in at, or your old roommate was able to get. Rates go up, rates go down. Your opportunity to get lower rates are going to be there in the future. Those people who got even lower rates might refinance to slightly higher rates because they're going to pull out equity or do something. People's rates will change. Nobody keeps a mortgage for that long to where they ever realize the full economic and interest impact of a loan. So the fixation should not be on that. It should be more on the property and your lifestyle. And I know that's what you guys are going to chat on as well.
That's awesome and super helpful. And if any of you guys have any questions too, don't forget to type them into the chat. And if we can't answer them now, we'll definitely follow up with you guys after this call. I want to pivot to a little bit now about the bubble. So I think, there's all kinds of headlines saying the bubble is popping, all this stuff. So Blakely, I want to hear a little bit more about like what exactly is a bubble and what are you seeing out there?
Yeah, so just pure definition of bubble. You need 2 things for there to be a housing bubble. And we saw this in 2008. You need there to be overvaluation and speculation. And so I'll go into like what those 2 mean, but overvaluation is probably pretty obvious. Prices are overvalued, homes are overvalued. And some people may argue that in some places they are. Right now, they're overvalued. The spring market was hot. Even though rates were higher, the spring market was really, really hot. And in fact, rates went up from, the peak of the thick of the pandemic when you saw these like really low 2 rates to this most recent 2022 spring. rates went up about 2 percentage points, if not more, and it did not slow the market, the housing market, one iota. So this whole talk of rates are causing the bubble to pop is just not true. But overvaluation means homes are overvalued. And again, I think that there are probably some pockets, some micro markets where that might be the case, but at large, we're not, we do not expect, or we do not see that homes are overvalued. Secondly, and more importantly, is speculation. So this is what led to, in large part, to the 2008 housing crisis that Arjun noted on earlier. You could get a loan, you don't have to prove your assets, you didn't have to prove your income. You basically just had to have a pulse, and you could get a loan, and you could get it for no money down. You could get interest only. You could get these crazy loan products that homes you couldn't afford, really. But the reason why they were giving them out is because people speculated that the home value was just going to keep going up and up and up and up at these crazy artificial numbers each year. And so eventually you'd just be able to afford it because the home would be worth so much that it doesn't really matter. Well, that was wrong. Homes don't go up that amount every single year. That's not normal. And so there was a lot of speculation back then. No, we have no indication at all right now that there's any sort of speculation. In fact, loans are incredibly hard to get. I mean, I like sometimes associate it with, like, I don't know, some like a colonoscopy or something. It's like literally like they are looking at everything. I mean, you have to provide so much documentation in order to get a loan right now. And so you are not getting a loan in a product in a home that you can't afford. It's a very different environment. And I think what we're seeing right now, we are seeing a little bit of a cooling period right now. It's pretty typical for summer cool, people are traveling, people are gone, but we are seeing a cooling off period from the spring high and the high of the last 2 years. And I think that's driven right now. It's not a bubble, it's not popping, it's cooling. I think that's driven by some misinterpretation on rates. People think that the only rate that they can get, we've got clients who are built their own models, and it's great. I love it. They're, super analytical, but they're going in there and making assumptions on their rate being at 7%. And that's just not the case. And so there's some misinterpretation on rates. And obviously we would be remiss to not talk about the stock market being down. That is definitely impacting, especially first-time home buyers, impacting down payments.
Yeah, and I think what I'm seeing too is that in this particular moment in the market, it's definitely an opportunity for buyers. The trade-off, we talk about trade-offs with all of our clients. To those of you that have worked with us, this. We're constantly having to pit what is most important to you. And one of those things is money, right? And with the higher interest rates right now, if you're buying today, the cost of money is a little bit more, it is more expensive than it was a year ago. However, what we're currently seeing is that our buyers, without the competition, are able to get more of the characteristics of a home that they were, that they couldn't get if they were shopping around a year ago.
Yeah, and then just to kind of expand that, so buyer pools we still have an imbalance of supply and demand, more demand than we have supply. But the buyer pools, the demand is shrinking a little bit because of rates. That's pricing some people out. And the down payment is pricing some people out, the stock market being where it is. And so buyer pools are shrinking a little bit. Days on market are staying pretty steady. So homes are still moving, in 2 weeks, sometimes 3 to 4 weeks, but they're still moving quickly. And we are still seeing in a lot of cases multiple offers, but far fewer offers than we were seeing, in the spring or over the last year or two. So as Cynthia said, definitely some opportunities for buyers. And then Cynthia, if you want to pull up, and I'm going to read Stephen's comment in just a second, but if you want to pull up the other piece of note as well, the inventory kind of levels today versus where they were in the housing bubble of 2008.
Yep, I've got it. Here we go.
Yeah, totally agree, Stephen, about your comment in the chat. And this is really highlighting exactly what you just said. And we'll talk a little bit too later about just the imbalance of supply and demand with the population growth. But, back in, this is actually a really interesting chart taken from National Association of Realtors. So this is national, this is not Bay Area specific, but you can see the, highlighted is it's a little bit dated at this point. We're ticking up a little bit right now, but we are still at very historic low inventory levels. And on the next slide, it compares the peak of 2008, the housing crisis, just before that, just before things went south, we were at 3.81 million homes were available. We are now less than a third of that, 1.03 million. And those are homes that are currently on the market. About 400,000 of those are actually in contract. So those cannot be purchased. But we have about 600, a little over 600,000 that are currently available. So still really, really low inventory levels. But we are seeing buyer approval shrinking a bit too. I also want to talk a little bit about the media and the media's role in all of this, because this is not to totally throw Diana Olick from CNBC under the bus, but she is, many people, really respect her. She does a lot of real estate reporting. She's an Emmy award-winning journalist. She's been around for many, many years. And I just want to kind of, just as an example, and this is not to pick on her, but as an example, again, the media sells fear, they sell clicks. And so I just want to do a quick example. This is literally her words, her headlines over the last few years. So in 2015,
is it showing?
Diana,
yeah.
Sorry, go ahead. Yeah, you can go ahead and click the next.
Oh, got it. Yes. Diana
said, we're in a bubble larger than 2006. That was in 2015. That year, home prices went up 5.1%. If you owned $1 million home, you made $51,000. Okay, so then fast forward the next year. She conveniently forgot in 2015 that she had called it a bubble. She said, okay, we're in a new bubble. We're in a new bubble this year in 2016. Well, guess what? Home prices went up 5.4% that year. Again, if you still own that same $1 million home, you made another almost $57,000. In 2017, the next year, she said, a recent study found that homeownership doesn't build wealth. And she also said in another moment, half of the housing market is overvalued. Houses that year went up 6.1% nationally. Again, that same home that year, you made another $67,000. She then in 2019, now I will give her that she had no idea, no one knew the pandemic was coming. I totally will give her that, throw her that bone here. But she did say 2022 or 2020 is going to be a really, really bad year for housing. Guess what? It went up 16%. So I just want to, I share this example because I think it's really important to understand what drives the media. The media drives fear because that's what sells clicks. And so if you guys are ever confused or concerned or have questions about, hey, I read this in the media, is it true? Like, let's just have a conversation, because a lot of times they are, I know Arjun, you have some opinions on this too, but they are not necessarily being paid to tell the truth.
Right, yeah.
All right. Yeah, I love those. It just like shows the power. I think too, one of the things that I take away from that chart too, is every time I look at the home appreciation is kind of the power of that appreciation, as we're talking so much about interest rates and housing bubbles and stuff like that. Regardless of that, houses are appreciating assets. And we always say to our clients, what matters most is not timing the market, but time in the market. Yeah. And so as we have started to hear and talk a lot about inflation and read about inflation too, we've also heard the common phrase like housing is a good hedge about inflation. And so Arjun, I wanted to kind of lob this question to you. Like as we hear that phrase, like why is buying a home a good hedge against inflation? And like, what do those numbers look like?
Well, I mean, just simply put, as an asset class, real estate has outperformed almost every other asset class. And there's been no bigger creator or galvanizer of wealth in the United States for the average, citizen than owning real estate. And that's because of the three, main benefits of ownership. There's the tax benefits, which you get to realize from day one. Your mortgage interest is deductible up to a certain point. There's limits. And then also depending on how you file your taxes, and you can consult with a CPA for the specifics on that. I have a short back of the envelope formula that people can use to try and just eyeball it. But you've got the tax benefits, which again, you don't get as a renter. You're paying somebody else's mortgage instead of paying your own, which is the second point, which is amortization. You're writing yourself a check when you own, as opposed to paying your landlord's mortgage. Because I joke and say you're paying a mortgage one way or the other. It's just a matter of whether it's yours or somebody else's. So amortization means you're the landlord now, and you're paying something down that you own. And then you have appreciation. And as an asset class, it has always outperformed, and typically in inflationary periods has done well with inflation, because right now we have housing inflation. So if you own a home, that home is going up by way of all the demand and the amount of people that are looking for homes, and there being too few homes available to sell. So you've benefited from that. And if you're trying to break into it, obviously it's tough. I'm not sugarcoating that at all or discounting that. Yes, it's tough. It obviously makes it even all the more sweeter when you do finally break in with the right team and the right strategy and the right timing. But you need to get on that ladder is effectively what the moral of the story is, so that you're actually moving towards something, because whether it's inflation or whatever is going on in the economy, this has been one of the safer asset classes. I'm not saying it's completely immune to any sort of volatility. Yes, there's some ups and downs if you look at the graphs really specific, but over the long run, real estate always outperforms.
Yeah, and I love that. That's what I love about that last chart too, is it actually outlines like what is that cost of waiting to you, and what does that look like? And so we'll talk about too. And Mahesh, I see your question, and we'll talk about that a little bit later. I want to get back to the recession. So that was a little bit about inflation. I feel like we're all like pretty well versed in inflation right now. We're seeing, the impacts of that at the gas price, at the gas pumps, et cetera, at the grocery stores, stuff like that. But as we know, and what we're hearing a lot about too, is that what follows periods of inflation is recession. So Blakely, I'd love to hear your thoughts in terms of like, what do you see coming, and why?
Yeah, so I'll caveat this with no one's got a crystal ball. This is not trying to be financial advice here, but we do study this a lot, and I know Arjun does as well. And we follow a lot of experts in the space. And the general consensus right now, and I think the couple of charts that we showed earlier, and I think Cynthia, you're pulling them back up, are super helpful. Rate hikes from the Fed tend to lead to recessions. So that's one thing that leads us to believe right now we are headed towards a recession, or a recession is looming. A lot of economists predicting Q4 this year. So we'll see, but that's what a lot of economists are predicting for this reason. The other reason too, I think that's really important to note as well, is tracking unemployment. And a lot of people think, recessions never happen when unemployment is really low. Well, if you look back over the last 100 years, with pretty much 100% certainty, anytime unemployment has gotten to its lowest level and then started ticking up, that is a signal of a recession. Why is that? That doesn't make sense. Like, unemployment is so low. Why would that be a recession? Well, what's happening is in a recession, unemployment right now is about 3.6%. So is that the lowest? I don't know. Is it going to start ticking up? Maybe. But once it starts ticking up, that is a pretty telltale sign of a recession being looming. Because businesses are doing well when unemployment's low. They're hiring, they're providing people jobs. Those people are spending money. In the last few years, they had stimulus checks as well. They were spending that money. It was great. When businesses aren't doing so well and they start laying people off, those people slow their spending habits. And when they slow their spending habits, the businesses that relied on them have to slow as well. And so when we see that tick up in unemployment, that's a pretty good signal for a recession. So we'll be monitoring that for sure. And then I think the other thing I want to note too, we talked a little about this before, but that is that. And then if you go to the next slide, if we do move into a recession, let's just say it's Q4, with pretty much every recession, with a couple of exceptions, but generally speaking, recessions drive mortgage rates down. And you can see it highlighted in the yellow sections. You can see each of those vertical bars are the recession, and the yellow part is showing you the mortgage rates going down. So let's say you lock in a rate today that's good, but not excellent. Guess what? In probably about a year, you'll probably have an opportunity, maybe even 6 months, an opportunity to refi that and get that rate down. So that's one thing to note. And then I also want to note too, because I think people really associate recession with housing crisis in 2008. That was an anomaly. We are in a very different context. We touched on that a little bit earlier, but generally speaking, when rates come down in recessions actually end up being good for housing. So I expect housing, and we'll talk about this a little bit later, but I expect housing prices to continue to appreciate, but at slower levels, especially if we end up hitting this recession.
Yeah, that's all. And Arjun, I know you've been in the business for a couple decades and you've been through a couple recessions right now. So you have lived through, you have seen this happen in real life. And I know, we've all got our kind of like war stories of the last recession and the housing bubble. And so it's really hard to like separate like how this one is different from, how the housing crisis of 2008 is different from what we're currently experiencing. All right. So I wanted to, Blakely, follow up too with like, given everything that we've been talking about with inflation being high, and we know that the Fed is increasing rates in order to get that under control, and that we are in this kind of period of cooling down because stock portfolios are down and interest rates are up. So what are you seeing in the market right now, and what are the demographics that are at play? And Arjun, please feel free to chime in on this one too.
Yeah, so I'll just start and then obviously Arjun will
Go
jump
for it.
in. So we're seeing, I think the biggest demographic right now that's really interesting is benefiting from the current situation is what I call seller buyers. So people who currently own a home and need to sell that home and then are going to buy a new home. And a lot of them have been sitting on the sidelines. They haven't needed to buy in the last 2 years. And so they just said, you know what, it is craziness out there. I am just not going to buy. I'm going to sit on the sidelines and just deal with the home, or maybe do some home improvements or expansion or something. And their equity just kept going up, 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 up. Home equity is at a record high right now. And so those, sure, if the market's cooled a little bit and their home is down a little bit in value, they still have a tremendous amount of equity in their home. They're selling that home and then they're benefiting on the buy side, because let's say they take a little bit of a haircut on the sell side. A lot of times they're buying a home that is bigger, better meets their work from home needs, in a different area that maybe is more expensive. They're upsizing, whatever it may be. And that home is more expensive. And so they're getting that little bit of a haircut too. When they're buying, it's a bigger haircut than when they're selling. And so everyone, of course, wants to time the market. Everyone wants to, sell high and buy low. But I think it's something, as you said earlier, timing the market is more important than timing the market. And it's just not possible to time the market. And so we're seeing a lot of seller buyers. I think it's really interesting because we work with a lot of first-time home buyers. And I think that demographic right now is the most confused about what's going on. I talk with a lot of boomer clients, and they're like, why is everyone freaking out about rates? My first mortgage was 18%. My first mortgage was 13%. They're not bothered at all by the rates right now. But first-time home buyers and people who have been, thinking about buying for the last 2 years, and that was kind of their start, the start of them thinking about buying, are fixated on the 2% that they didn't get, and not fixated on 4% is actually not that bad, or whatever they can get. And by the way, I could refi down the road and get my monthly payment lower. And so I think they're the ones that have maybe some of that, lack of, I don't know if it's perspective or what it is, but we're seeing first-time home buyers pull back a little bit more. They were really the ones, the last 2 years, they were 30 to 40%, depending on where you were, of the market, of the buying market. And so they were driving that boom in the last 2 years, and then pulling back a little bit because their down payment has been eaten up a little bit in the stock market, and interest rates are now so crazy high. That pullback is really impacting that coolness. So I think the people that have that perspective and can see the big picture and see, oh, maybe if I can get in now when things are a little cooler, and then just refi down the road, I think those are the ones that are really winning right now. But I think that the first-time home buyers, Bank of America predicts that 2/3 of millennials will buy in the next 2 to 3 years. So I think, they drove, the ones that have already bought, drove the last 2 years in large part. I think they're driving that pullback right now, is driving some of the cooling period. And I think that they will drive a lot of the future demand in the next 2 to 3 years.
That's really well said.
Nice. Yeah, I know, Arjun, you work with a ton of clients too, and it sounds like you're seeing exactly a lot of the same kind of demographics that we're seeing a ton of millennials get into the game and start to plot their home purchase.
Yeah, definitely. And, I think whether it's perspective or whatever, the reality is I think everybody just got very spoiled by seeing rates with a 2 or a 3 in front of them. And you just have to recognize, like Blakely said, it's not the mortgage you're going to have forever anyways. So yes, while it might have been great to get that, you don't need to feel like you missed out because, there's an expression going around, it's all over the internet or all over social media. You date the rate, you marry the house, right? So you're just dating the rate. It's very short-lived. If anything, you're speed dating for this next year because you're going to move on past it quite quickly and move on to something else. But you're going to be the winner in all of this because you'll have gotten in on an asset that is probably appreciated, even conservatively, at 5 or 6% over the course of the next year, as opposed to paying 5 or 6% more with a slightly lower interest rate at that time. So, you just pick which side of the equation you'd rather be on. I'd rather get in, considering that every mortgage is front loaded with interest anyways. It doesn't matter what rate you have. The majority of your payment is going towards interest in large part for the first few years. So that being said, the rate is really almost moot in the early stages. But if you can get in and it's the right house and it's the right timing for you, not trying to catch a falling knife or time the market, like Blake was saying, but for you personally, the personal decision is right for you. I think you stand to gain quite a bit over the course of the next year and then well beyond that.
Yeah, well said. Yeah, and I think too, before we get into kind of closing thoughts and our final points, the one thing that I know that we all talk about in terms of really driving the San Francisco and the Bay Area market as being a little bit different than the rest of the country is inventory, right? And I know we looked at the chart earlier, and Stephen, you asked a question too about like, isn't inventory like down right now? I'd love to hear specifically, Arjun, from you, like what you're reading in terms of inventory, what you know about inventory. I think we're known to have a limited inventory. San Francisco's a tiny little 7 by 7 square foot area with crazy politics that don't allow for building, stuff like that. But like, what is going on with inventory?
You said crazy politics, and then you finished it with that don't allow for building.
I know. I know.
I thought you were just going to leave it there, which I don't think there would have been much argument with anyway.
I know.
That's for another webinar. We can do that next time. No, I think specifically, this is about inventory. So we need to kind of look at what's being said, first of all, which is everybody reads constantly. You're inundated with the headline that there's an inventory shortage in the US. There's an inventory shortage in the Bay Area. And there is. As Cynthia correctly pointed out, we have very limited space, not a huge ability to build, only vertically. There's not a lot of available land where single family residences can just, be plopped up. And if we look at it, I think to make it a little bit easier for everyone to understand just on a broader or almost national level, there's 2 major reasons why we have an inventory shortage in the United States in general. These don't necessarily directly apply to the Bay Area, but it's worth mentioning because we need to understand the bigger picture at play here. One, builders are extremely gun shy and have PTSD from 13 or 14 years ago when, as I think it was Stephen that put this out into the comments, which is 100% spot on. There were more homes than there were available buyers. So going back to your simple supply and demand, if you've got way too much supply, not as much demand, what's going to happen to prices? They're going to invert. Builders got caught holding the bag when the music stopped. You also had loans disappear, so no one could even get financing. And then builders were just basically having to do fire sales on these homes. So a lot of them are very, very gun shy. Of course, the last few years and all the supply chain issues and labor costs, lumber costs, everything factored into have not helped the equation. So you're going to see this backlog of building, which is just not going to catch up and meet current levels of demand anytime soon. And then the other reason is the labor markets. The majority of homes that are owned in the United States, particularly in the Bay Area, are owned by middle and high income earners. So if you look at what happened during COVID, because a lot of people thought when COVID first happened that, the market's going to crash. Here it is. This is 2008 all over again, when in actuality, the opposite happened. And not just the opposite, the polar opposite happened. Homes declined 20, 30, 40% in 08. They took off by 20%, and in some rare cases, even more in certain markets over the course of the pandemic, but we just didn't see all this inventory hit the market the way that some people were kind of calling for. And we call them housing bears, like people that were calling for the housing market to really slow down. The Bear Brothers or Crash Brothers, that's what they get referred to as, kind of the peanut gallery on the internet that's always calling for it. It just never happened because most of those people owning homes, they just stayed. Their jobs weren't affected by COVID. They didn't feel any need to sell. They already had a home with space. Meanwhile, everyone else was trying to get a home with space or leave these cities and move somewhere where they could have more room and work from home more efficiently without killing their spouse, whatever it might be. And so you just didn't see this glut of homes hit the market. To Steven's point, and I'll wrap with this, what would it take? And some people have even asked, I think Mahesh and Gayatri even asked, like, if home prices were to come down, what would it potentially take? I think we just have to play that back very simply. So anytime I hear something that's, a doomsday headline or a major shock point or clickbait, what I try and do is just play it backwards. Okay, what would it actually take for this thing to play out? Rather than just read it and take it at first glance, what would it take to play out? So for home prices to come down, we would need that whole balance to shift, more homes and less demand. So we need more buyers to exit, and we would suddenly need to have more homes just hit the market. Well, to the earlier point I made, the majority of homes are owned right now by middle and high income earners. And unless they're looking to upgrade, because everyone needs housing. So when they sell their house, they typically get a new house. They don't just leave and go back to renting. But for homes to hit the market, you would suddenly need a lot of educated buyers. And I say educated, meaning they've been thoroughly vetted, as Blakely correctly stated. They've been through a gauntlet to get approved. They're overqualified. They're sitting on a lot of equity. So you would need a glut of educated homeowners to suddenly decide to sell their homes at a major discount when they're sitting on a lot of equity. So that's not going to happen. And then just go back to renting. That's what it would take for housing prices to crash. Housing prices can come down. And I think that's a big misnomer in headlines that you pointed out, that where they're coming down. You both see this because you're very savvy agents and you watch the market closely. Homes that are inappropriately priced, and this is done sadly by inexperienced listing agents that aggressively price a home too high because they just think the market can be there, or they're trying to get top dollar for their client, they're being reduced. So the media sees that as price cuts. Prices are being slashed, prices are coming down. When in actuality, they're actually just coming down. And this is, again, more your expertise, so I'll let you comment on it, but they're coming down to where they should have been in the first place. Homes that are appropriately priced in line with the market typically sell at that point, and they don't come down. So we're not going to see this like huge inversion of prices unless something happened to the labor markets for middle and high income earners and they just decided, I have to sell my home and leave. Then we would see a major shock and see prices really, really invert. So until that happens, I think we're going to have some kind of price stability. Yes, there could be some corrections and pullback in some market, but I think that's just things coming back down to earth, not sinking below the line.
Yeah, I agree with that 100%. And, all of those headlines, again, back to crazy media, just looking for good clicks, like those headlines that say this house sold for $1 million over asking, but yeah, you're exactly right. The market value versus where it was listed at are two very different numbers. And oftentimes the market value is pretty comparable to where it actually sold. So it is a pricing strategy. Pricing is a strategy. So it's a good message to like be careful of not correlating the price of a home to the market value.
And then just jumping in here, I know we're getting close to time. There's a couple questions in the chat I do want to get to. But people ask me, okay, you've got a crystal ball, what's going to happen the next year, right? And our price is going to keep going up double digits, like they have the last 2 years. And so here it is. Here's my assumption or my prediction on the market. But really, I'm just repeating what others have shared. But one, no, we are not going to see the kind of growth we've seen the last 2 years. It's just not sustainable. And it would not be healthy. So I know everyone wants that. That'd be great. But homes will not, on the flip side, homes also, I do not expect and do not forecast seeing any sort of decrease in value. Most people, most economists, most like the National Association of Realtors are predicting, mid single digits. I've seen 5%. I've seen National Association of Realtors says 4%. or 7% for the rest of this year and 4% for 2023. I've seen some predictions on the next slide in the 11 range. So Zillow saying a little over 11%, Fannie Mae saying about 11.2%. So, somewhere in that range. The point is home prices will continue to go up, but at a more modest amount. I think that's the TLDR. I think the other piece of this too that we can't neglect is home prices to build are also going up. So lumber has gone up, inflation is impacting everything. Gas prices are impacting shipping costs. All of these things are impacting the cost to build a home. So even if we all of a sudden had all these homes on the market that could just be ready like that, cost of the last year has gone up almost 20% to build. And so prices, you just can't build as cheap as you could when you're buying a home that was built in the 60s, 70s, 80s, 90s, whatever. So that's what I would say there. And then Janet, if we have a recession, what do you think will happen to the vacation home market? Great question. I think so we didn't get into this too much on this call, but we do talk a lot about, we track like new home formations and relative to supply, because I'll go back to supply and demand, and relative to new build and new construction. The thing that's driven a lot of the market as well in the last 2 years, those crazy numbers, is people wanting to get out of their room, having the ability to work from anywhere, going and Airbnb, a place in, if you're in the city in Sonoma, or going and Airbnb, a place in Montana or whatever. And so that vacation home market has gone up. I do think when we talked earlier about the bubble and overvaluation and speculation, I think some of these vacation home markets, in some cases, are overvalued. And so I do expect some of that to dip more than we see some of the primary, places like San Francisco Bay Area.
Yeah, I'm happy to chime in on that too. I actually, I bought in Big Sky, Montana in 2006, which is a secondary market. We call that a secondary market, exactly what you're talking about, Janet. The economics were really different at that time. So, and I was living there. It was not my second home. It was my primary residence. And that market crashed hard. We saw that whole secondary market just totally get obliterated. My home value was cut into half. And it took 12 years to recover. And I know that there's a lot of people who are saying that in some of those markets, it's like just now recovering from that former crash. I think what's really different about this time, so I am working predominantly here, which is a primary market. We've got colleges, people are living here full time. It's not a ton of people buying. The majority of the market isn't buying second homes. So I'm going to caveat this with, I'm not, in the weeds of the vacation rental, the second home market. But I think what's really different is the money side of things is really different right now for even those second home buyers, in terms of the kind of like very loose lending that was happening in 2006 isn't happening right now. Like these people that are buying these homes in these vacation markets are buying them they bought them at really low interest rates or with cash. It was a ton of tech money moving into there, buying them up for cash. And so I don't think that we'll get the foreclosures we were getting in those vacation markets, but TBD, like I think it's still TDB or TBD in terms of like if they're going to sell and if that's going to increase inventory. So I don't expect the foreclosures that we saw in kind of like the recovery period of 2008. But it will be interesting to see. I think those markets are the ones that are currently, I would say, overvalued. I think that's where those headlines are actually more applicable, is that they are overvalued. So it'll be interesting to see if those second homeowners do have to actually sell in order to come back and be in the office in their big cities. So,
and I think to that point too, Cynthia, because of those, we touched on this earlier, the stricter lending guidelines.
Yeah.
Even in these markets where there might be a 5 or a 10% pullback, most all second homes required a minimum down payment for those who did finance of 10, if not 20% down. So they're still likely going to sell. If they had to do a fire sale or just exit it because they needed to get out of there and they're not going to be there and they need to get back to work in their primary city, whatever the case might be, they're still likely going to sell and not lose their shirt on the home. The foreclosure crisis really, what really spun it the way that it did to uncontrollable points where there was no money being put down on the house. So you borrowed at 100% of the home's value, and then suddenly the home dipped 10%, you were truly underwater.
Yep.
And which was what inspired so many people, whether you agree with it or not, to just walk away and say, that thing isn't worth anything. I don't want to pay for it anymore. So I'm just, here's the keys. I'm out of here. I don't care if my credit gets wrecked. And that just continued to let, prices, crash and continue to fall. But the second home market, obviously not in that anywhere near that same type of situation or storyline that was happening years and years ago. So even if people exit, they're still going to be selling at probably a pretty fair and honest price, not at a massive discount. And they're still going to walk with some equity, some of their down payment, if not all of it. And they'll need housing elsewhere, or they'll stick their money, that money in the bank, and move back to their primary home.
I have lots of thoughts and feelings and emotions of that topic, Janet. If you want to talk offline, I'm happy to.
Durango is a great place. I've been to Durango. Beautiful
Awesome.
place.
Shall we wrap up?
Yeah. Yes. Closing thoughts. Do we have any left?
I'll just say this. Thanks for including me, of course. I love working with the two of you, and I'll just tell everyone this. I'm not just saying this because we're on this together. We talk all the time, and both these agents, what I respect about them, and I think this really says a lot considering some of the names on here, because some of these are people that I talked to over a year ago, and they're still connected to Blakely and Cynthia, which I think says a lot, because a lot of buyers and people that I know are prospective buyers, or even people who already bought, they're not in contact with their realtors at all. That, the realtor hasn't even sadly checked in on them. But I know Blakely and Cynthia do a really good job of that. And what I respect most about them, aside from the fact that they study data and we kind of geek out over the stuff and talk about it over happy hours and just catching up, is the fact that both of them own real estate as well. They walk the walk. So when they're talking to you about home ownership and the benefits of it, they're coming at it from, a place of actual familiarity, and not just telling you to do something because it's a trend or because they make money from doing it. Yes, they make a living doing this, but they are really advisors, and I respect them, tremendously for it. And again, obviously, some of the folks on here that have been in contact with me for, a long time, or that I've talked to or even met a long time ago, you must feel the same way if you are still, tuning into things like this and getting information from them. So I just wanted to give them praise, because I think very highly of both of them.
Thank you.
You are, June.
We love working with you as well. And I'll just kind of end with, I heard this the other day, and so I'm not making this up. This is something I'm just repeating from someone else I stole. But there's two kinds of people in the world. There's innovators, and there's imitators. And I think that this is, a lot of people just sit by the sidelines and wait to, read the media and read the headlines and just kind of wait to see what everyone else is doing. And when I give advice, I always try to put myself in the shoes of buyers or sellers. And I'm not the agent that's always saying, oh, now's a great time for buyers and for sellers, and it's to everyone. Because I don't think that's the case. I try to put my money where my mouth is, as Arjun, as you said. And so I was saying in May, June of 2020, when everyone was saying, oh, there's a mass exodus from San Francisco, I was saying, buy, this is a good time to buy in San Francisco. And I did, we did,
I have video record of that, because we filmed something in 2020. She was saying that very thing. So yeah, it can be backed up.
So I do think if you're thinking about buying, if you already own a home, great, you are in a great spot. Let it continue to ride and appreciate. If you are thinking about buying, I think now is that time to be an innovator and to really think differently and think bigger, longer term picture about things, because the rest of the world is kind of stopping and thinking and sitting by the sidelines and just waiting to see what happens. And so I think if you're thinking about selling, it's kind of a time to think about, is this really the right time? Why do you need to sell, and what are you doing? If you just need to sell, you just need to sell. And if you have a lot of equity because you've owned your home for a long time, you're going to be fine. Maybe you didn't sell at the peak, but you're selling still for, fine. If you can hold it for a little longer, I think things are going to be a lot better for sellers in, the next 9 months or so. But the one caveat to that is, if you are selling to buy something bigger or more expensive, this is a good time to sell and get the advantage on the buy side. So that's what I'd say. That's the advice I'd give. If you're thinking about buying, I think this is a great time. Thinking about selling, let's chat about if it's right for you or not.
And my final words are, may the only bubbles that pop be champagne bubbles. That's kind of our motto.
I love it. These are Instagram handles. If you don't, I think everyone already follows us. If you don't follow Arjun, follow him. He's amazing, super informative. Thank you guys for joining. This will be recorded. So if you have any friends that you think would like to hear this or tune into any of this, let me know. We'll share it out and go get that glass of wine. Happy Wednesday, guys.
Thank you.
Thanks, everyone. Have a good evening.